Okay, what I want to do tonight is, because you're focused on paper 4 right now, I want to just do a real quick recap on the hardest parts of paper 4, just to make sure you're clear on what to do on that. So I want to just walk through what those things are. And so there's a few things. The hardest one is the net working capital requirement. Net working capital requirement under liquidity. And then I want to talk about capacity versus turnover under turnover. Then talk about earnings growth versus revenue growth under margin, and then a real quick talk on ROE. So those are the 4 hardest things people have. So the key on the net working capital requirement, first of all, is to make sure you're looking at dollars, not CAGRs, to determine if it is a source or a use. I'll show you with Walmart exactly what I mean by that. And the second thing is look at the bottom of print page 1 to see the components so that you can talk about drivers of net working capital requirement. So, and don't forget that negative is good, positive is normal, and then, so don't get into the habit of saying, oh, their net working capital is negative, so it's a source of cash, so they're good. Oh, this firm's net working capital requirement is positive, so it's a use of cash, so they're a terrible company. Remember, most firms, their net working capital is a use of cash, and that's pretty normal. And so if it's negative, it's if a source, a higher CAGR is better. If it's positive, that's a use. A lower CAGR is better. So these are the biggest mistakes students make, especially on paper 4. The biggest mistakes are actually under liquidity, and these are what they are. So let's look at Walmart just once again. Now that you've had a chance, because I think some students, we go through it and it's like, boy, that was fast. And now you've had a chance to look at it. So let's go back and just, now that you've looked at your firm and you've had some numbers, let's look at Walmart again. So for Walmart, line 2930 are working capital assets and liabilities. Remember, working capital assets exclude cash. Cash is not a working capital asset. It's a current asset, but it's not a working. It's not tied to operations. Operations produces cash, but cash is not part of operations. And then working capital liabilities, I do take off a lot of points if students try to explain their net working capital requirement by talking about debt. There is no debt in working capital liabilities. So debt cannot explain why it's going up or down. So some students would say, well, they paid off some debt last year. That's probably why their working capital did better. No, that makes no sense. All right. And so the key is Walmart a source or use? Some students will look in column B and they say, oh, look, 6.7, it's a positive number. So net working capital must be a use. Well, no, that's the wrong column. You want to look in column C. Net working capital requirement's a negative number. The assets are less than liabilities, so it is a source. Because it is a source, you'd like for the growth rate to be as high as possible. If it were a use, well, you can't get a growth figure there because I'm changing from positive to negative. But if it were a use, you want the growth rate to be as low as possible or even negative. All right, so just make sure you're clear on that. So the key with Walmart is that their working capital requirement is a source, and it's been doing extremely well. It's one of the fastest growing things they have on their income statement. Look at everything else is 2%, -1%. Nothing's growing except for their liquidity. Liquidity is much stronger, and so you go to the bottom of print page 1. We can look down here and see here's the liabilities, but what we notice very, very quickly is that the biggest asset and the biggest liabilities are really tied up in the 2 numbers. And so their inventories have been growing more slowly than their payables, and that is the main reason why Walmart is becoming more liquid. They're using payables more, which is a great way to fund the company. You know, it's like free debt. You don't have to pay interest on it. For the most part, probably for Walmart, never at all. They probably dictate to their suppliers pretty harshly. But you do want them to keep their inventories under control and keep them as low as possible. So, you know, their inventories are growing fast relative to their revenue. Their revenue is only growing, you know, it's growing well, I guess it's in line, 2.44. And inventories are growing somewhat in line with revenues, but their payables are growing even faster. So for Walmart, you can see the whole reason why their net working capital requirement hasn't been improving, they become more liquid, is because of that they're utilizing the accounts payable more. All right, so look at all those lines, bring them together. Make sure you're looking at the dollars. Look at the bottom of print page 1 to see the components. Remember, negative is good, positive is not necessarily bad, it's just normal. If it's negative, higher CAGR is good. If it's positive, lower CAGR. Now, the only other issue we have is the graph. So you have a graph that does net working capital ratio to CFO. And, you know, lower and negative are the best, but you have to be careful. It is possible for some of you that something is going on with CFO, the cash from operations. They could have some unusual item there, some big write-off they had, or some big add back, whereas CFO did something strange. And so the relationship, the graph itself, it's going to show something there that has nothing to do with the net working capital requirement. So just be careful of that. You might look at your CFO and see if it's doing some strange things, because there are other things that impact CFO besides just working capital. Working capital is usually the largest one, but you remember on that graph, what is it, 7 or 8, I can't remember which one, where they show the components of net income that gets you to cash from operations, and you have that one thing called other. And some of you, that other line is just quite volatile, and that can create some noise in that graph too. So just be aware of that. You have to kind of look back and forth to see. What I really recommend that you do is get paper 4 written. And, you know, if you want to send the whole thing to me and talk to me about it, that's fine. But what I prefer that you do is get the whole thing written, and then let's talk about these most difficult sections. Most students know if CFO is growing at, you know, 13%, that's good. You know, you can say strong growth. You don't need my help and input on that. Most people say, you know, if net margins are improving, that's good. If they're better than the industry average, that's good. If that's lower than the industry, that's good. You know, most of these are really straightforward. So what I recommend you get paper 4 written and then come to me with these most difficult sections. And that may be what we do. If we do Zoom sessions on papers 3, 4, and 5, we might really focus our energy on the hardest parts of paper 4 and maybe give you some help on paper 5. I don't know if paper 3 I can help you too much, because it's, you know, every company is so different. We'll see how we'll work that. All right, any questions on liquidity? Hopefully you've gotten a good draft of paper 4 going, or almost done by now. So I would, you know, do your best you can on the hardest sections. Now, on capacity versus turnover, what you have to do here, you need to first pick the best turnover for your industry. Remember, for Walmart, I did revenue per square foot. Some of y'all could probably use revenue per square foot. Those of you doing Costco, revenue per square foot makes a lot of sense. Most of your industries, though, revenue per square foot doesn't work, because you're not really retailers selling out of stores, and I don't have the list of companies with me, unfortunately, so I can't remember. So doesn't really work. If you're technology or anything where it's just, but it's hard to find something, the revenue per employee is a good one to always fall back on. If you're big manufacturing, you got a lot of property, plant, and equipment. That's one way to tell. Just look at your property, plant, and equipment. This might apply to Lockheed, although I think with Lockheed, I'll probably use revenue per employee. But if you have a lot of manufacturing, your property, plant, and equipment is a big part of your balance sheet, then I'd use revenue per PP&E. If you have stores, but you don't really have good square feet, then revenue per store is a good way to do it. I am going to get, this next weekend, I will get R&D. So if I get R&D, some of you have firms that do a lot of R&D, like NVIDIA or something like that, where R&D is a big part of your business. I'll have those numbers this weekend, so you could go ahead and do paper 4 using revenue per employee, and then wait and see when you get the R&D numbers, see if that gives you better analysis. Marketing, advertising, revenue per marketing, revenue per advertising can be a good one to do. If you're doing Nike, Capital IQ does show marketing for Nike and Adidas, and so you could actually look and see how much the revenue they're getting for each advertising dollar. So there are some you can do with that. You have to be able to get advertising dollars, and I didn't bring that in on the Bloomberg, so you'd have to get it out of Capital IQ. You could probably get R&D out of Capital IQ, but bring it in.
What is line 63 liabilities? What is that telling us?
Line 63 in Walmart?
Yeah.
Well, it's just all the other working capital assets. Most of that's probably accrued expenses. It's a lot like accounts payable. I mean, the biggest thing in there is probably accrued expenses and then deferred revenue. I mean, unearned revenue. So like Shamir is doing airlines. Airlines have huge unearned revenues because you buy an airplane ticket, you pay them today, and you may not fly for 6 months. So man, that's wonderful, right? You just borrowed money for 0 interest for 6 months. That's about as good as you can get. So it's a lot like accounts payable. You want that number growing as fast as possible. I try to take deferred tax out, and for some firms, deferred tax is really huge because the tax law changed. Unfortunately, I brought the deferred tax line in, but I don't think every firm uses it. So it's possible some of your firms are getting messed up with the deferred tax. I say it's X deferred tax, but I'm not 100% confident on that. So yeah, so let me show you what he was talking about. Sorry, I'll forget that when I switch that y'all don't switch. It doesn't switch for y'all. So yeah, line 63, other is, you know, accrued expenses is that's, you know, payables to your employees because they work, you haven't paid them yet, and just all other accruals that you have, and then unearned revenue. And Samir, I probably should have broken out unearned revenue for you. That would be an interesting one to look at. I imagine it's done quite a nosedive this year. It was interesting with me dealing with United because we bought the tickets for the student trip for the investment society and we're able to get all the money back, and just me thinking about an airline sending back that much money, you know, pretty much every one of their customers sending money back. Where they got that money is pretty amazing. But that unearned revenue would have been in this line. All right, so let's keep talking about turnover here. So pick one that's best for your industry. If you can't figure one out, then revenue per employee is not a bad one to do. And then what you got to do is you got to do capacity growth versus turnover growth. And some students really get confused on this. So capacity growth, you're just looking at whatever's in the numerator. I mean, a denominator. So it's the growth, the CAGR of the denominator. And this is the CAGR of the ratio. All right, so look at Walmart. This is real important that you put those both in there, and then you comment on what is driving revenue growth. Is it capacity or is it better turnover? You want it to be better turnover. So let me remind you, showing you here Walmart. So Walmart, I'm going to go up 34 and 35. You might be using lines 36 and 37. But we can see with Walmart, they grew their square feet 1.52%. Their revenue per square foot improved 0.7%. So you look at their 2.4% growth in revenue. A lot of that growth is coming from just adding more buildings, adding more square feet. So very little of their growth in revenue. And think about that line 35. You would expect line 35. You might get this in your notes somewhere because I think it's important. you would expect line 35 to just grow with inflation. You would assume companies are growing their revenues just at least with inflation. But 0.71, inflation's been about 1.7% the last 10 years. So Walmart's revenue per square foot is not even growing with inflation. It's like they're not even raising their prices. So inflation goes up 1.7%, they don't raise their prices at all. So it's pretty weak, all right? So that's what you're comparing. Line 34 is your capacity. You add more stores, you have more capacity. You're adding growth by building new stores. Line 35 is your turnover. That's the number you want to be driving things. That's where you want your growth because that's the cheapest way to get growth. Now be careful. Let's say your employees' CAGR is 4%, or let's go higher than that, is 7%, but your revenue per employee, CAGR, is 5%. Be careful not to say this firm's doing really badly because your employee growth is higher than their revenue per employee. It's not necessarily that the 6% is, that the 5% needs to be higher than the 7%. That's not the key. The key is how skewed is the growth coming from adding more employees, and then is this a good number? This is still a very good number. Most firms would kill for a number where they're growing their revenue per employee by 5%. So the fact that it's lower than the growth in employees is not negative. What would be negative is if this were 7% and this was growth in employee and revenue per employee is only 1%. That would be bad. So think about that inflation number. If you've got revenue per employee growing greater than 2 or 3%, that's probably pretty good. In this environment, that's probably pretty good, even if your employees grew by 5 or 6%. All right? So it's not, some students get confused that it's whichever number is higher, that's the important one. That's the one that's really driving it. It may just be the firm's growing fast. They're adding a lot of employees, but they're getting a lot of good revenue growth from those employees, so they're still doing well. So that's still good, all right? That's the capacity versus turnover. A lot of students lose points on that one. And then this next one is on their margin. And all I'm looking for here is really simple. You want to talk about economies of scale. What you want to say, if economies of scale or to scale, I don't know which it is occurring in a firm, one would expect earnings to grow faster than revenue. It's just obvious. You had that in your accounting classes when you did contribution margins and all that kind of analysis. If firms have fixed costs, then a 2% growth in sales should cause a 4 or 5% growth in earnings. Most of your firms, this is something really interesting about this last 10 years. Most of your firms that I've seen, the revenue growth and the earnings growth are almost identical. It's like there's absolutely no economies of scale out there at all. And I think it's just because the competitive nature of the world right now, firms are not getting any kind of financial leverage at all. I mean, operating leverage at all. It's entirely just, if they get revenue growth, they don't get to keep any of it. They have to give it all back to the customer or whatever. So very few of your firms are demonstrating any economies of scale. The few firms I see whose earnings growth is faster than revenue growth, a lot of them, it's like just the last couple of years. It's not this consistent thing over time. So that's what I'm looking for. It's a question of, it's also operating leverage. It's the existence of fixed cost. If a firm has fixed costs, that means when revenues rise, their costs don't rise. They should get a good kick to their earnings growth. Why we're not seeing that? I wish I could go back 100 years and seeing this as an unusual period of time that we're in. We're just not getting any margin expansion whatsoever. All revenue growth is just coming at an enormous amount of workload, other than the Facebooks and the Googles of the world, maybe even Apple, but it's still, firms are having to put a lot of effort in to get revenue growth, but they're not getting keep much of the revenue growth because it's really not flowing down to the bottom line. They get $1 in revenue, they get $1 in net income, or they get 40 cents in net income. You know, it's just a constant ratio. All right, so that's that last chart on their margin. A lot of students lose points there because they don't realize what I'm trying to get to there, which is economies of scale. And then the last thing that students struggle with is the ROE. So the ROE is going to be a function of ATO times margin. That's your last graph before you get into ROE. It's going to be a function of financial leverage. You have that graph that shows how levered they are, and then it's going to be a function of the tax impact. So what I'd recommend, we talk about that in the class we did it, but just to remind you, get those 3 graphs together. Let me show you again with Walmart. When you get to this section, just put those 3 graphs together. You're on print page 2. So you have chart 14 or 14A, either one. So you can take that one and put it down. You have your financial leverage. I only have that for the 2 companies. I don't have it for, you really just want to be focusing on your company, but so you have that chart. And then a chart you probably won't put into your paper, but you should still just look at it. And that's the very, very last chart, which is the tax impact. And so when you look at those 3 charts, you're trying to see what's going on. For asset turnover times margin, we can see Walmart has been slowly declining over time. For financial leverage, they've been very, very constant over time. They're essentially 1.5 the whole time. On the tax impact, they saw a jump up here in this last year, and you saw a jump up in financial leverage. So chances are their ROE jumped last year. It almost has to.
Professor, what does the tax impact mean?
The tax impact is essentially the percentage of their income they keep after tax. So if their tax rate's 40%, then the tax impact should be right at 60%. It should be 1 minus their tax rate. So higher is better there. So you can see in their ROE, return on equity, see how it jumped up in 2020. Why did it jump up in 2020? Well, partly because their financial leverage went back up. So this dip right here is related to their combined financial leverage. I can't explain why it dipped down and came back up. It's really, there's some accounting irregularities going on. And the other reason ROE is up is because of the tax impact. So it's been trailing down over time, and that almost perfectly reflects what's going on in ATO times margin. And so you can see with Walmart, their ROE is dropping mainly because their asset turnover and margin is dropping. But you're really trying to explain the ROE chart. The shape of the ROE, because remember the ROE of chart 15 is nothing more than chart 14, 16, and 18 multiplied by each other. So just putting those 3 together. So the shape of this chart is going to be explained by these other 3. Your challenge is to find some way to explain them, and sometimes it's kind of messy because they're all over the place. So that's what you're trying to do on that one, is try to explain what's driving return on equity. Is it the good thing? The good stuff is chart 14. Asset turnover margin, that's where you want to see a firm going up. You can see with Costco, theirs looks really, really good, but it's almost entirely driven by higher financial leverage. It's not because their asset turnover and net margin are going up. So that's what you're looking for in that last little section. So what I recommend you do before you write your paper is go into Excel and put these 3 charts next to each other and put the ROE chart right below it, and think about what you're going to say before you put it into the paper, and then go to put it into the paper. Make sure you understand it, because what I find a lot of students is they try to do the ROE by reading what's there for Walmart and trying to adjust it, and it's just too confusing to do that. You've got 3 things going on at once, and Walmart's just going to confuse you. So I'll be really clear in your mind what's driving these things before you go to the paper, all right? So those are the four things. So if we do a Zoom session, and I want to do a Zoom session on paper 4, or 4 and 5, I'll probably focus entirely on paper 4 on those 4 things, just to make sure, because those are the places people usually lose most of their points. All right, let's jump on the paper 6. Any questions on any of that though before I do? We've got pretty good.
Professor Sweet,
Uh-huh.
is there any way you could, I think I missed it in the first 5 minutes, the revenue per square foot? I don't understand specifically because I'm looking at my Lululemon Bloomberg and my graph is like empty. So I don't know if that's because it doesn't apply to Lululemon.
Yeah, I don't think it applies to them. Some places, even like a Disney, it's true Disney and Apple have square feet, but it's not a big part of their business. I don't know Lululemon that much. I know they have some stores, but I'm not so sure. They don't do a lot online or whatever. So
it's probably because the
cases,
revenue doesn't come from the stores, like mainly.
Well,
Is it worth it discussing in the paper?
No, I wouldn't do. If you don't have a chart, then move the revenue per employee.
Okay.
Now, if you have revenue per store, some firms, square feet is an as-reported data, which means firms can report if they want to or not. Stores, number of stores is as reported. So it might just be they just don't report it. It's not available.
Yeah, because in the actual, like the other Excel, it just has an NMF.
Right. If they don't report it, then you just have to hide those lines. Do they have anything for revenue per store? Yeah, so you're probably going to be stuck with revenue per employee, which isn't the greatest thing for Lululemon.
They have per store too.
They have per store. Okay, you might, if 80% of their sales are online, or if they're selling in other people's stores, then revenue per store really wouldn't make that much sense. Like, think about a Disney. Revenue per store doesn't make sense for Disney because they have, movies and theme parks, and so the Disney store is an incredibly small amount of their business.
Mm-hmm.
So they probably don't even report that. Same thing with Microsoft. Microsoft has the stores where there's almost never anybody in them, but not a big part of their revenue. So revenue per employee might be what you'll have to focus in on. If you can find their advertising budget, you might look on Capital IQ and see if you can get their advertising. Revenue per advertising spend would be a good one for Lululemon. I don't know how much I've never seen a Lululemon advertisement, so that might not work either. But that's why I say, if you cannot find anything, fall back on revenue per employee.
Okay. All right. Thank you.
Sure. Anything else? Definitely get your first draft of paper 4 completely done, 3 and 4 done this week, and then start working on the forecast this weekend. The papers due, I can't remember. Let me look real quick. But
on the 30th.
30th, we got, let's see. Yeah, we got 2 weeks. So I might next week think about some sessions for Zoom. I like to do it a week in advance. But it depends on you having a good draft ready to go to be able to do that. So that would be my preference. So you got paper 1. I know a couple of y'all are still turning in paper 1. You need to get that out of the way as quickly as possible so you can get on the paper 2, paper 3, 4, and 5. But yeah, by this weekend, I would have 3 and 4 almost completely done and start working on your model for 5. Paper 4 is not that bad. I've done it as an exam in a class, and students can finish it in an hour and a half and 2 hours. So you can get a good first draft in under 2 hours. It might not be wonderfully, beautifully worded. So the wordsmithing may take some time, but you can get a good first draft pretty quickly. All right, let's talk about paper 6. I know your minds probably aren't ready to get into 6, but we have to not get too far behind. So paper 6 is a more theoretical paper than the others. It's a really, really good paper to make sure you've got a good understanding of cost of capital. All I'm asking for in paper 6 is the cost of equity. So you don't have to do the full cost of capital. I've had a few students do the full cost of capital, but we'll talk about in paper 7. If your firm doesn't pay dividends, we can still do we can still use CAPM and use regular cost of equity. We don't have to use a free cash flow model, but we'll get into that. So paper 6 is the discount rate. So think about paper 6 and 7 together. Paper 6 is your discount rate. Paper 7 is your discounted cash flow. Those 2 papers go together. If you took my investment class, like Damaris, who took my investment class, and a few others of you. Alfredo, man, a bunch of y'all have taken my class. What we did in paper 3 and 4 in that class, you're welcome to use your paper 3 again and edit it. You don't count it off for plagiarism if you're plagiarizing your own paper. This is a case you got to be careful of plagiarism though, because this is the part where, especially the risk-free rate and the market risk premium is not company specific. So some students are tempted to just copy and paste someone else's, but don't do that because the safe assign will catch it. So put it in your own words, but you can definitely look at the other papers and see some of the things they're talking about. But essentially we're coming up with a discount rate. The discount rate needs to cover inflation, needs to cover the real risk, the real rate of risk-free rate, needs to cover risk and human nature, but really purchasing power and the real risk-free rate is all covered by treasury yields. So we'll combine those together. And human nature is captured in all of them. So really all we're going to do is a risk-free rate plus a risk premium. This is one area of finance you should be an absolute expert on. It's one of those areas that they just expect you in interviews to know this really well. So if you've forgotten some of this stuff, it's a good chance to refresh your memory. I'm going to assume you've forgotten all of it. So this might be a little bit kind of rehash, hopefully for y'all that you've seen this all before. So what we're going to do is find a discount rate specific to your company. So the first question we have to ask is the risk-free rate. So let's go to the end product here. Let me give you the end product so you can see what we're after. So we are going to use the capital asset pricing model. If you want to use another model, I guess that would be okay, but my word, you're going to have a 60-page paper because you're going to explain the model. If you're going to use some arbitrage pricing theory model or some other theory. So my guess is 100% of you use the capital asset pricing model. Y'all know this really well. The cost of equity equals the risk-free rate plus beta times the market risk premium. So you need 3 numbers. But you really need 5 numbers. And I'll show you why you need 5. So let's think about what we're after. The risk-free rate has traditionally been the 10-year treasury. All right, so that's straightforward. The market risk premium, most of you are going to use the implied approach, but you'll notice some of the papers discuss other approaches. There are others out there. There's the implied approach, historical, and then there's the Vix approach, there's the corporate spread approach. There's a few others that I don't think even work. The dividend discount model approach doesn't work. But those are a few of them that are out there. When I started at UTSA, when I did my first evaluations, we were still using the historical approach. It was the most common approach. Almost 100%, really 100% of people are using historical approach as far as I could tell. And Dr. Ibbotson from University of Chicago, he published a book every year that gave us the historical approach. I don't recommend you do the historical approach mainly because it's hard to get your hands on the data these days. So I don't recommend that one. These others, and if you want to get into the others, one thing I'll definitely offer to you is JP Morgan has a study that they did. It's really old. They've updated it every year, but I don't have access to the updated numbers. Many years ago, probably 11 years ago, the JP Morgan study was being passed around at UTSA in everybody's inbox. We're supposed to read it, initial it, and pass it on, and I just took it home. I didn't even let anybody else see it. I just took it home with me because I thought it was so good. And I thought it was great for my class because what they did is they go through all of these approaches. And they have a couple of others that I don't think work, but they have them in there. And they give some history. They talk about the pros and cons of each one. So I emailed the 2 people at JP Morgan that did the study and asked them if I could photocopy that for my class. And they said, yeah, sure, no problem at all. I had an employee at JP Morgan, and he said, I got access to the people who wrote that report, so I'm gonna be able to get you the updated report. And then he quit and went to another firm and didn't get the report to me. So I don't have the updated one, so it's very old. It's old, so the data's old, but the approaches are still good. I don't know anyone at JP Morgan now that could get that report for me. Maybe I should go email those guys again and see if I can get it. But if you're interested, if you want to get into this in more detail, you certainly can. Or if you want to, you can just stick with the implied approach. So the implied approach, I like the implied approach because about 15, 20 years ago, everybody moved to the implied approach because of a study that Barclay, I'll actually show you this, the Barclay study. So the implied approach has become the most common. I like it because you don't have to have a tremendous amount of history. It's very theoretically sound. It makes a lot of sense. And it's not that complicated to do. So we'll probably use that approach. The Vix approach is just to say that the market risk premium should be some fraction of the volatility index. So some say that it should be 30% of the volatility index. So if the volatility index is 20%, then the market risk premium should be 6%. So, I don't know where they got the math on that, and I don't know if that number's been updated. The corporate spread approach says when corporate spreads on bonds are wide, then the market risk premium should be high because corporate bonds are measuring risk, and that's a measurable number that we can go out and get. Unlike the market risk premiums, there's no place to go get it. It's not published anywhere. You have to derive it or use somebody else's assumption. But corporate spreads are out there, and you can see if corporate spreads are unusually wide or narrow. And because of that, you can use that to back into what the market risk premium should be. And there's a couple other approaches, but these are the main ones. So my guess is most of you will only use the implied approach. It's definitely the one to use. And then the last thing you need is beta. And on beta, we're going to use a 4-step process. That if you've taken my 3013 or my investment class, I use that process in there. I really like that process. And you're going to have, this is very, very important, you're going to have a base case, a best case, and a worst case. And and with the paper 7, I don't know how many of you have used data tables in Excel, but I strongly recommend that you use a data table in paper 7, which means you might have more than 3 cases. You might have 10 or 15 cases of beta. Remember, your best case is your lowest beta, because that's going to give you the highest valuation. Your worst case is your highest beta. So we'll talk about that. There's some videos I have that you can actually, for doing paper 6 and 7, there's videos that I've created to help students in my investment class. So if it's been a while, or if you're not really sure on this, I'll make those videos available to you so you can see. We'll actually do them in class ourselves, so you'll have the class as well. So I'll be essentially writing an entire paper 6 and 7 in class at a real high level summarized way. So there's the numbers we need. Now we have some issues here. The risk-free rate, what do we do with such a low 10-year treasury? What is it right now? Like, I think today it's back down to 0.7%. Boy, I can't remember, 0.7% today. Let's see. I don't think it went below 0.7, but so 0.73%. Crazy. That's absolutely crazy. 0.73%. Remember, the lowest 10-year treasury rate we've ever had in U.S. history prior to 2020 was above 1%. The 10-year treasury has never been below 1% in its entire history for 200 and whatever years it is. And then suddenly in 2020, we got it down to 0.5%. So just ridiculously low numbers. What do we do with this? So there's 3 approaches. You can just use the actual number. Now that is the easiest approach. You can certainly do that, but you got to talk about it in your paper. You can't just say, my approach is just to use whatever the number is and forget about it. No, you got to discuss why you think that's appropriate. Now, down below in the notes, I have a link to a Dr. Damodaran blog. It's a few years old. I think he's updated it since. So if any of y'all can find a more recent one, send it to me. I just got lazy and you can go out and look for his most updated one. But he has a blog where he talks about how you deal with low treasury rates. That was at a time when rates were a lot higher than they are now. So that's why I think I think a student found that he had actually updated that. So I should go out and find, if I find an updated one, I'll get it to y'all. So has been his approach. Just use the actual number. Now, several years ago, my approach was to normalize the number. To assume there is some normal, real risk-free rate plus expected inflation, and that's what the 10-year should be. So I can go back and look, and I had some charts that demonstrated that. I don't like that approach anymore, mainly because we've been abnormal for so long. It's hard to say what normalized means anymore. So my preferred approach today is the forward curve. I've got a video on that if you want to use the forward curve approach. It's just using the forward treasury yield. So it's just, just looking at what 20-year treasuries are and what 10-year treasuries are and seeing what does the bond market think the 10-year treasury will be in 10 years. So we get out of this abnormal period of time with the Fed doing things and all this just noise going on, printing of money, all this. Let's say we get out of that in the next 10 years. What is the market saying the normal 10-year treasury is going to be 10 years from now? And so that's the forward curve. So if you want that approach, there's some videos. They take about 15, 20 minutes to watch. One reason I like the forward curve approach is not necessarily because I think it's the most theoretical answer, although I do think it's a pretty good answer. But I like it also because a lot of students have never done the forward curve before. And if you've never been exposed to bootstrapping the yield curve, this would be a good excuse to go and learn it. It's not that hard to learn, and formulas are pretty simple. I think theoretically it's okay. One of the reasons Damodaran says just use an actual number is because you can't invest in the normalized number. It doesn't exist. But you can actually invest in the forward curve. You would just buy the 20-year treasury and short the 10-year treasury, and you now have the 10-year treasury 10 years from now. So you actually can execute the forward curve. It is actually possible. So that gets around that argument that he makes for why you should use the actual number. So you have to deal with that. That's probably going to take you 4 or 5 paragraphs. You can look at what former students have done. I definitely don't mind you reading other people's papers. Just make sure you go back and put it into your own words. Realize as you get further back in time, they didn't have the problem with the 10-year treasury being low in some of those earlier papers. And so, some of the more recent one, like the Microsoft paper, he did a great job on that. I forget, a couple of papers from last semester did a good job on that. The CarMax paper would probably be a good one to look at. He did a good job on it. So, all right, so that's the risk-free rate. You need to talk about that. When I do the actual example in class, I'm going to do the forward curve approach just because I can show you real quickly how to do it, and the math is pretty simple. The implied approach, the key there is how you're going to work it with the risk-free rate. So I'll walk you through the implied approach, and you'll see how that works. We'll get into some of that today. In fact, I might spend some of the class today on the implied approach. And then beta. So we'll spend quite a bit on beta, probably the next couple of classes, or at least next class. So make sure you're ready for beta. And I might not get back to the risk-free rate until I do the in-class example of papers 6 and 7. So you can see the full way that I do this. It used to be, when I was doing this 25 years ago, it was a piece of cake. For your risk-free rate, you just got the 10-year treasury. For the market risk premium, you just got Dr. Ibbotsson's historical number. And for beta, you just pull beta, you just got the beta for the company. Piece of cake, everything was easy. Right now, we're in a period of time where all of these numbers are suspect. So, are any questions on the high level, what we're after? This is your paper 6. It doesn't look like much, so a lot of it's discussion, deriving the numbers. And the beta is probably the easiest because the process is really straightforward. And I'll probably handle that next class and walk through exactly what I want you to do there. All right, so paper 6 is a good theoretical. Make sure you know this stuff before you graduate kind of paper, but you also have to come up with some assumptions for your company. So let's talk about the market risk premium. So the market risk premium, I'm down on page 32 of the notes. Demodaren has papers on the market risk premium. I'm going to show you one from Barclays, but Demodaren does have papers on the market risk premium. I think I have one of his linked down here. So here's his paper down here. I'm probably going to jump to that here pretty soon, but let me walk you through. So the theory says all stocks, the stock market expected return should be the risk-free rate plus some risk premium. And for the stock market, we call that risk premium the market risk premium. That's for all stocks. So for the average stock, how much extra return do you need over 10-year treasuries to induce people just to invest in the stock market? Not in one particular company, but in the entire stock market. So that's the overall market. For your stock, for a stock, an individual stock, expected return, it's going to be the exact same formula, risk-free rate plus some risk premium. But we need to adjust for your company's specific risk, and we're going to use beta to do that. So the market risk premium is essentially this extra return you need to induce someone just to be in the stock market. So it'd be what discount rate you use if you're valuing the overall stock market. So we need a number for that. So where is that number? Well, it's not published anywhere. There's no place to go to see what is the market risk premium. You could survey investors and see what they're using. That approach has actually been used by some people. I think it's a terrible approach because most people don't really have a process that they know what their number is. They're probably giving you a number that hasn't been very scrutinized. The market risk premium is the premium of how much extra return you need to induce people to buy stocks. If people don't think the stock market's priced to give them a good return over treasuries, then they'll stop buying stocks, they'll sell their stocks, prices will fall, the expected return will rise, and stock prices will fall enough, and the expected return will rise enough until it's high enough to get people to come back into the stock market. So there's a very efficient market type of argument here. The two most common approaches are the historical approach and the implied approach. Dr. Ibbotson is the guru on the historical approach. I heard him on a podcast not too long ago. I've met him once. Interesting. I might have met him twice. I can't remember, but I met him at least once. He's still going. He's retired. He doesn't teach anymore, but he's still going. He's still involved in markets, doing a lot of consulting work. In fact, he might have a consulting firm now that he uses. So all he did is he said, okay, his argument was what investors have gotten in the past is probably comparable to what they're going to be requiring in the future. So if in the past, and let's say history says stock return was 10% and the 10-year treasury yield was say 5, or let's say 6% or 4%, then the market risk premium would be 6%. Real straightforward. You just take historically and say, why did stocks actually return? Oh, 10%. What was the 10-year treasury yield, actual yield? Oh, 4%. Then historically, stock investors have gotten 6% more than they would have gotten from treasuries. That must be their market risk premium. Now, there's an obvious, horrible problem with that, and that is how much of this 10% was actually what investors expected, and how much of that was a surprise, either positive or negative. It's possible they needed a 9% return, but stock surprised on the positive and gave them a 10%. So maybe their market risk premium really isn't 6%. Maybe it's really only 5%. They just had a really great history here. So Ibbotson's argument is if you go back far enough, he goes back to like 1928. If you go back far enough and do enough history, then those surprise periods kind of cancel each other out, and you end up with a good risk premium to use going forward. But the problem with that is you have to pull so much history. So if you don't have access, he called it his annual yearbook where he gave you all this data. It was a pretty amazing book. I loved it. I was always excited when it came in because it had really good data in it and really interesting charts. And he gave us some data we couldn't get anywhere else, especially getting stock returns back to the 20s. He was about the only one to give us that. So it was great. And we use this historical approach, but it does have that one flaw in that it just assumes stock investors got exactly the risk premium they were expecting. So I don't recommend, especially I've had some students do the historical approach. Well, they'll just look at the last 10 years, and you absolutely cannot do that. That's where a historical approach is really weak. So Ibbotson said, if you're going to use the historical approach, you better have a lot of history. And so that's the downside of it. You need so much history. So let's do the implied approach. So I recommend you all use the implied approach. And what the implied approach says, and that's what Damodaran, if you use his article, he's using the implied approach, and it makes perfect sense. He doesn't quite go in as much detail as I do. I love the implied approach because if you think about it, it makes good theoretical sense. So what we're trying to do, our goal is to come up with the required return on stocks. The required return on stocks minus the risk-free rate equals the market risk premium. But there's no place to go out there and see what is the required return stock investors have to get them to get in a stock market. They say the only way I'm going to buy stocks if they make at least 8% or 9%. That's my required return to cover me for risk. We don't know what that number is. So we're going to substitute the expected return on stocks for the required return on stocks. Why is that? Well, if the required return on stocks is greater than the expected return on stocks, so let's say investors need a 10% return, but they expect stocks to make 8%, what's going to happen? Well, no one will buy stocks. Everyone's going to sell their stocks. The stock market's going to crash 20 or 30%. When the stock market crashes, what happens? The expected return goes up because you're buying stocks at cheaper prices. So stocks crash until the expected return equals 10%. Now realize if the stock market crashes, people might get really risk averse, and so the required return goes 11% or 12%. Well, the stock market just keeps crashing until they finally get to that number. If the required return, come on, Bill Gates, is less than the expected return, so they require an 8% return, but stocks are priced to give them a 10% return, everybody's going to be buying stocks. So stocks rocket up until the expected return falls to 8%. So this is the efficient market. Power, it's the power of the efficient markets. Efficient markets make a lot of sense. It doesn't make sense for stock investors to keep buying stocks if the required return is greater than the expected return. So, it just makes perfect sense. It's a very logical theory. So I like it a lot for that reason. So we cannot come up with the required return on stocks, but we can absolutely come up with the expected return on stocks. And here it is right here. The expected return on, this is the stock market. Make sure in your notes you note this. So we're talking about the stock market. I take off a bucket load of points. If you do this specifically to your stock, this does not have anything to do with your stock. The risk-free rate and the market risk premium have nothing to do with your stock. So the expected return on the stock market is the current dividend yield of the stock market, not of your stock, but of the stock market. All right, make sure you have that in your notes. Plus the expected earnings growth of the stock market, not of your stock. All right, so I can show you a chart on that. I'll do this. I'll show the charts when I do the paper 6 and 7 example, because that's a place you can put it in the paper. So I'll bring those charts in when we get to that point. I have charts that actually show that this is actually a pretty good assumption. So stocks should give you the current dividend yield, which right now is probably around 2% or so, maybe a little bit lower, and expected earnings growth. So the question is, so the current dividend yield you can pick up. The current dividend yield, you can just take this, you can just take the SPY current yield. Let me show you that real quickly. So we go back into Yahoo Finance here. We go find the SPY. The SPY is the S&P 500 in an ETF. And you see its current dividend. Oh, what did I bring in? SPY. Oh, there it is. Wow, look how low that is. 1.69%. Y'all see that? So 1.69%. Yeah, boy, it's definitely, firms have been cutting back in their dividends, and we're almost back at all-time record highs on the stock market. So dividend yield of the stock market is really, really low. Obviously, its beta is 1. It's amazing that its year-to-date return is positive after COVID-19. But that's the dividend yield. So you would actually use this number for your model. Now, you can round it up to 1.7 if you don't want to use such a unrounded number. That's fine. But that's the number. So whatever number this is, just SPY on Yahoo Finance, whatever its yield is, that's what you're going to use for your current dividend yield. So that's real easy. So what we need is the expected earnings growth. Now, one little caveat we'll bring in here a little bit later, and we have to address the issue of stock buybacks. So we'll get into those later. I'll show you what you can do on stock buybacks. That is a big issue now. It used not to be a big issue, but firms are buying their stocks back so much that it's actually a higher yield than the dividend yield right now. So firms are actually putting more cash, and you are seeing this on paper 4 for a lot of your firms that are doing a lot of stock buybacks. So we'll come back to that later. Let me highlight the stuff that I'm adding to the notes here. So the current dividend yield is easy. So the question is, how do we get this expected earnings growth of the stock market? So we're not focusing on your company at all here. So the expected return, expected earnings growth should be a function of expected economic growth. They should be very similar. And I'll show you next class. I'll actually get into this a bit more. I'll show you the Barclays study and how they did that. So I'm very much following the Barclays study. They're the ones that came out with this implied approach. I saw this at a conference, and actually saw this at a conference presented by the Barclays people, and started using it immediately. I immediately stopped using the historical approach and immediately started using the implied approach because it just made more sense to me. So our earnings growth should reflect economic growth. And the nice thing about economic growth, and I'll show y'all this next class, is economic growth has 3 really obvious inputs: productivity growth, labor growth, and inflation. And those are numbers that are actually not all that volatile historically. And so we can go and look at historical numbers. I'm tempted to show you tonight, but we're coming up on the hour, and I want to give you all a little time ask questions. So I'll show you. I need to show you a chart. There's a chart here you can use, and there's a chart here you can use. So there's some charts that I've built for you that you can use in paper 6 that will really help you a lot and come up with these assumptions. And this is a pretty important number, this expected growth in earnings, because for your company, when you value your company in paper 7, you're going to have 2 growth rates. You're going to have a short-term growth rate and a long-term growth rate. And the long-term growth rate for your company will probably be very close to this expected earnings growth. Most firms, when they hit their terminal growth and they become a normal company, you expect them to grow somewhat in line with the overall economy. And that may not be true without an Exxon or a Chevron or some firms you think that maybe they won't be around in 50 or 100 years, but for most firms, we think eventually they're going to grow like the economy. So we get the expected return on stocks, we subtract the risk-free rate, and that gives us our market risk premium. So here's the buyback argument. I'll get into that. I'll show you the paper on that. So Thursday night, I'm trying to decide what I'm going to do Thursday night versus do when I do papers 6 and 7. We'll see. I'll figure that out. So there may be some of the stuff I'm going to delay until I do my full-blown paper 6 and 7. So I think Thursday night, probably what I'll do Thursday night is really focus in on the beta and how to come up with your beta. So we make sure when you leave class on Thursday, you know how to do the beta for your company. You might not do it immediately because you're still working on papers 3, 4, and 5, but you can come back to that video and make sure you understand it. If you've had me before, you know that. All right, so I want to stop questions because that's a lot of stuff. I will strongly encourage you that if you're like, man, this is all Greek to me, you need to go back and learn this stuff. This is really critical for undergraduate finance majors to know. This is like the most basic. This is the stuff that if you don't know in an interview, they're not going to talk to you anymore because this is about as basic as you can get. And some students just forget about it because they get hit with it so many different times in so many different ways. All right, so any questions up to there? I'm looking at the class, probably about a 30 of y'all have had me before, so you've already seen something really similar. If you haven't had me before, it's not a problem. You can definitely get this done. It doesn't save you that much work to have already written.
When I have a question.
Okay.
Sorry. When it comes to this paper, would it be it's very similar to 3 and 4? Is it okay if we use like the same definitions or explanations that we use in those papers?
Yeah, I have students that do copy their paper 3. So safe aside, you might say there's 60, 70% overlap. And if I click on it and I see that you're copying your paper from my investment class, it doesn't bother me at all.
Okay, and when it comes to the beta, that's the rolling beta we did in that paper, right? And the sensitivity tables?
Right, we're going to do that same 4-step process again.
Okay, all right, sounds good. Thank you.
So if you're doing the same company you did for that class, you still have to update it because you have more recent data. And you have a new dividend yield, you have a new 10-year treasury, your company has more stock data, so you can't just, you don't have to definitely update the paper, but you can definitely use the same definitions and, very similar. If you got a good grade on that paper, then yeah, you'll probably do similarly. I don't really grade it that much harder in this class than I did in that class.
Right, but
your paper 7 will be quite a bit different because I want you to do, although I've started adding the data table into that class, in the investment class, so there'll be some, but you'll be doing more scenarios in paper 7 than you did in the investment class. So paper 7 will be quite a bit different.
Okay, but even if we don't have the exact same industry, the definition is still the same, sir.
Well, the risk-free rate and the market risk premium are the same for all stocks. So that part doesn't need to be edited at all.
All right.
The beta, you'd have to do that from scratch. Yeah.
All right. Thank you.
So I will try to get some data for you this weekend. I'm up on campus teaching a class. If there's some data you really want out of Bloomberg that you don't have and you can't find it on Capital IQ, email me and I can probably pull that data for you. I don't think I can let you in the room, even though I'm going to be in there. If you really want in the Bloomberg room, I can check with Dr. Baynott and see if he'll let me let some students in. But probably this Saturday, I have a class at 10:45, so probably Saturday afternoon I'll be in the Bloomberg lab for 4 or 5 hours pulling data. All right. Nothing else. If you're getting a draft or paper 4, 3, and 4, and you want to talk about them with me, set up some time, email it. We can look at it, and I'll give you information this weekend what I'm going to try to do with talking about your papers 3, 4, and 5 next week in smaller sessions. All right, that's it. Thanks, everybody.